Okay, it's now 10 o'clock, so I think it's safe to get started. I want to say hello and welcome so much to the Salvation Army's estate planning Zoom presentation. My name is Tim Kaiser, and I am the charitable gift advisor here in Saskatchewan, and I will be your host today. Today, we'll be hearing from George Drever, a friend and supporter of the Salvation Army here in Regina, as well as Jerry Gedir and CoraLee Baerg from Continuity, an estate planning firm based in Saskatoon. I'm really looking forward to this presentation, and I hope you are as well. But before we get started, just a few housekeeping items to go over. We ask that your mics and your cameras be turned off and keep them off during the presentation. We do encourage you though to ask questions, and if you can use the chat button on the screen below, that would be a huge help. Finally, we will be recording this presentation today. To get us started, I'd love to welcome you to introduce George Drever. Many would know George during his 50 plus years in the insurance industry serving Southern Saskatchewan. George is a supporter and friend of the Salvation Army, and I've really enjoyed getting to know George this past year. George, thanks so much for being with us.
Well, thank you for those very kind words. As Tim said, my name is George Drever. I grew up on a small family farm in Southern Saskatchewan. My father was a World War II veteran, and we also had a neighbor who was also World War II veteran and had spent 3 years at a POW camp over in Europe. And I learned about the Salvation Army from my parents, my father primarily. And this is how I found out about the Salvation Army. I went to work at quite a young age, and I would hear things, I would see things. I saw the Christmas kettles from time to time with the Salvation Army. And as I grew older, I decided to start to contribute to them on a monthly basis by the month. And then as I grew older, I started to do some estate planning a couple of years ago on myself. Instead of customers, I was doing it on myself. And I decided to contribute what some people would consider a reasonable amount of money out of my RSP, which, as most people know, is taxable. I guess that's your next question, Tom. I won't get ahead of myself. But I also had an employee working for the people that I work for. And about some time ago, he announced to me that him and his wife, his whole family, had begun working full-time for the Salvation Army. And so I learned quite a bit from him on the way you folks operate. Okay.
Wonderful. Well, George, my goodness, lots of information right from the get-go. It's every single time I have a conversation with you, I'm learning something new. You already mentioned that you've made plans to leave a legacy gift to the Salvation Army. That's extremely kind of you. Could you tell us why you decided to do this?
Well, the main reason was I think most people would like to think that they have done something during their lives, a worthwhile, whatever you want to call it. And I chose the Salvation Army. I guess it started with reputation, and then I had friends with the Salvation Army. And so I decided to donate to the Salvation Army. The main thing that impresses me with the Salvation Army is that they give help when it's needed, immediately, regardless of anybody's denomination, faith, position in life, status. It's just done, and that's what I like. And I also like to help the people that need helping. That's my idea of it.
My goodness. George, I love talking to you. I think we could talk about almost anything for at least an hour, but we better keep moving on. Just remember, the next coffee is on me, okay?
Okay.
All right. So now I would love to introduce to you Jerry Gedir and CoraLee Baerg. Jerry is the managing partner of Continuity, a firm specializing in succession and estate planning, for entrepreneurs and family businesses across Western Canada for more than 34 years. Jerry has written and spoken widely on advanced insurance planning, shareholder agreements, charitable gift planning, business succession, and estate planning matters. Jerry, that's a lot of stuff. Whew. All right, CoraLee provides planning for business succession, estate planning, wealth transfer, and charitable giving strategies. She enjoys providing technical solutions to complex issues in a way that is easy to understand. While they're sharing today, I'm just going to remind everyone that we have a chat button below. This is a great opportunity to ask some questions. For them, please use that chat button and we will discuss it at the end of the presentation. Now I'll hand it over to Jerry and CoraLee. Welcome, guys.
Thank you, Tim. And what an encouraging testimony, George. I mean, if you need to get sort of pumped about doing a presentation, I think this is the best way to do it. And to hear from people who are actually making gifts of a significant size like you are, and in such an efficient way as well. So hopefully we are going to provide, CoraLee and I are going to provide some little tidbits of additional things that we can add to that list of, or the menu of potential items that people could consider. And so we've prepared a bit of a presentation. I'm going to get that up on the screen now so that it's ready. And I guess the next thing I'm supposed to do is share a screen here. You've already mentioned, Tim, our work is, you mentioned that we do a lot of things, but really it's not that many. I guess in our world of the financial world that we work in, we very, very much specialize. And specializing involves dealing with helping people with succession and estate planning. Our primary market, the people we are working with, are probably the most significant donors anywhere across the country. And those would be entrepreneurs and their families in Western Canada. So both CoraLee and I and Continuity works across, although we live in Saskatoon, we work in Manitoba, Alberta, BC, as well as Saskatchewan, with advanced insurance solutions and gift planning strategies, if you've already mentioned, but very much philanthropy is part of our DNA. We want to help provide knowledge and wisdom wherever possible so that people can make a difference in the world. A lot of the differences that George was just referring to. So you've already seen us. We're going to skip through that. I want to share with you a little bit our planning process. And the first phase of planning, I think, is really getting to know what the customer really wants, getting to know them below the surface, not just trying to figure out, here's how much tax you need to pay, or here's the kind of way you should distribute your assets, or here are the probate rules in Saskatchewan, or whatever the case may be. We would like to go well below the surface. And one of the ways we do that is we use the Albert Einstein approach. He was once asked if he had 1 hour to save the world, how would he do it? And he says, I would prefer to spend 55 minutes defining the problem, and then maybe only 5 minutes working on the solution. So we spend a lot of time working in this area and getting to know what the issue is, what does somebody want to accomplish, what do they truly care about, and what is the legacy that they would like to leave. So beyond the discovery, as part of the discovery stage, the reason we do this, why do we bother spending so much time? Well, history isn't very good for people who are planning on leaving their estate. And whether it's a business and it's a small business that's going from one generation to the next in a family business, there's a 70% failure rate. Virtually the same kind of failure rate exists in estate transfers. And the biggest issue happens to be trust and communication. there isn't enough discussion in advance where the next generation can understand what has been going on. Mom and dad, for whatever reason, feel that this is my estate and people will find out when they read my will. And I guess we've worked hard to try to break that weakness. Also, failure to prepare heirs is another big issue. And with families we've worked with who've become involved in philanthropy, people have taken that as an opportunity to help prepare their heirs to understand what's important to them, pass on the values of philanthropy to the next generation, and get involved with the kids and the grandchildren before mom and dad pass away. Okay. Now, many people might think it's poor tax planning or it's poor legal advice. That's only 15% of the causes for why philanthropy post-transition doesn't happen very, very well. So we are trying to turn that around a little bit. Once we get into passing through the discovery stage, is where we spend most of our time, then we're going to be involved in creating solutions, implementing strategies. And Tim, I've shared this with you in our conversations previously. There's really only 3 places that a person's estate can be distributed to. And George mentioned earlier with RRSPs and RIFs, the government basically takes a big piece of the action there. The second area could be family, if usually government and then family gets what's left over. But I think we're forgetting using charity as an option for us to give to. So even if people are not charitably inclined, CoraLee and I basically would bring this to the front and say, if you had the option, if you could pick 2 of those 3 options that are available to you, which ones would you pick? And a lot of times they're saying, well, can I do them all? Or do I have to do them all? Or can I do 2 without doing government at all? And really, it's possible to do that. But you know what? It doesn't happen at the end of the day when the lawyer is reading the will to the family that's sitting in the boardroom table after somebody has passed away. It's really the planning that's got to happen in advance and to take advantage of these opportunities. So part of our strategy is to say, why do people donate? And George, you've got a philanthropic heartbeat. It wouldn't be hard for you to convince a lot of people because of your heartbeat. And so part of our discovery phase is really identifying what is that philanthropic heartbeat for any of the donors that we sit down to talk with. Then if they've indicated they would like to consider 2 of the 3 options, family and charity, then we could start speaking with them about gifting strategies. And most people, when they are shown that they can make a significant impact, will choose to do that. So over the years, there's been a lot of help. The government has given us about 30 plus pieces of legislation to be able to make gifts. And by that, I guess if you make a gift in our country, you get a tax credit on that gift of at your maximum marginal tax rate. So for us in Saskatchewan, that's like 47.5%. Even if you're not in that tax rate when you make the gift, your tax credit counts for 47.5% of that gift, almost half of that gift. Now, our government has spent a lot of money recently. I mean, spent a lot of money on COVID, well needed in areas where it's needed most. But when you spend money, when you buy a home and you get a mortgage, you normally have to repay the mortgage. And I think we as taxpayers in Canada can prepare for the other shoe to drop. So this is a new tax form. I'm kidding, of course. This is a new tax form that the CRA has come up with. Basically asking one question and making one direction. How much money did you make last year? Send it to us. Now, I don't think things are going to be that bad, but certainly we can expect a lot of taxes to increase going into the future. So what are we going to cover today? I will quickly summarize here. CoraLee is going to talk about some life insurance gifts. I will chat a little bit about Canadian pension and retirement asset kinds of gifts. CoraLee is going to talk about marketable securities. And then I'm going to basically show us a way that we can actually donate enough to eliminate all the tax. In other words, transfer all the tax from all the tax you would have paid, transfer that amount entirely over to charity. It is possible. So CoraLee, why don't you take it over with talking a little bit about life insurance gifts?
Sure. Thank you, Jerry. And good morning to everyone out there. So yeah, life insurance can really be used as quite a powerful tool to magnify both the size and the impact of a charitable gift. So we're going to cover three sort of different ways that insurance can be used in your estate planning, both with benefits at the end in your estate, as well as some of the benefits that you can receive during your lifetime. So in the first strategy here, this is assuming that a life insurance policy is personally owned, and then maybe you would like to name the charity as the beneficiary. So in this case, you would retain your ownership of the policy during your lifetime. You might consider or continue paying the premiums, or the policy may be paid up. And then the gift would be made to the charity upon the passing of the life insured on the policy. So in this scenario, the tax receipt is received in the donor's estate and likely to offset a potentially large tax bill at that time. So in this case, you would be able to monitor the policy during your lifetime and change the beneficiary if you ever were wanting to, but then you would receive that large tax benefit in the estate. So in our second example here, we're considering changing the ownership of a policy, or perhaps actually getting a new policy with the intention that the charity would own the policy. So this one functions a little bit differently. So when the charity is the owner of the policy, it has control of the policy during its whole lifetime. So then in that case, when you're paying the premiums on that policy, you'll get a tax receipt for the premium you pay each year during your lifetime. So a bit of a difference there of when you're getting the tax receipt. So if it maybe works out better, you don't need as much of a tax credit in the estate, but you think, hey, I could use some tax credits right now each year while I'm living, perhaps then this is a good option where you get the tax receipt annually when you pay the premiums into the policy, and then the charity as the owner of the policy would just receive the funds upon the passing of the life insured, and then there's no tax credit for the donor at the time of their passing. So it's just a difference there of tax credits perhaps at the end in the estate in strategy 1, or tax credits annually during your lifetime in strategy 2. So in our third strategy here, this is considering a life insurance policy that perhaps you've had for many years. So maybe you got it when you were a lot younger and life has changed. You think, oh, I don't really need this anymore. My family has grown up. I don't have a mortgage. I don't see quite the same need for it. So in this case, instead of just perhaps getting rid of that insurance policy, a really great and powerful option can be to donate that policy to a charity. So in these situations, if you have had the policy for quite a number of years, it's really important to get a fair market value valuation of that policy. And that's because, first of all, the charity needs to have that number so they can issue you a tax receipt for the value of the policy at the time that you donate it to them. So let's say you had a $1 million policy with no cash value in the policy. There still may be an inherent value to that policy of even hundreds of thousands of dollars. So it's a unique thing that can be done, and it's completed by an actuary to determine that fair market value. And that means that you would receive a tax receipt for whatever the fair market value of the policy is determined to be at the time that you assign ownership to the charity. So you would receive a tax receipt at that time, but then if you continued to pay the premiums on that policy into the future, you would receive tax receipts for those contributions as well. So as you can see, there's a few different ways that life insurance can be used as a charitable gift.
CoraLee, can I just mention one
Yeah.
idea here too? You mentioned that somebody no longer has a need for a policy. We work a lot of small business owners, and many of them have partnership insurance or shareholder insurance, and now they sell the business and they still have that insurance. And
Exactly.
that becomes, and they no longer need it. Or maybe they had a big bank loan at one point in time on their business and they needed it to be life insured. And so they could actually donate that policy that's no longer needed in the business. Would that be a possibility?
Yes, exactly. Yeah, there's many different ways that those insurance policies can be used. And I think it's important to also just think, yes, if you have an old policy for whatever purpose it might have been for, and if it's in a corporation, that's no problem. Consider how it can be used for the better good. And then those really do have a lot of value. Yeah. So really just looking at insurance, it can be a very powerful tool to magnify a charitable gift. And so now I think Jerry's going to carry on with the CPP and retirement options.
Okay, well, Canada Pension Plan. Everybody turns 65, and some people can even actually access this benefit when they're younger, when they're 60, and they could defer it until when they're older, when they're 70 or whatever. And but the point is that it's a benefit that if you've ever been employed in your own business, or if you've ever been employed with somebody else, you've accumulated dollars in a Canada Pension Plan. And that Canada Pension Plan is going to pay out a benefit. Now, I'm going to use as an example here a couple who's age 65, and their Canada pension amounts to today at maximum levels at 65 about $1,100 per month. So the two of them, you're getting up to $2,200 per month, right? Well, that's $26,000 per year. Now, all of that benefit is taxed at whatever your marginal tax rate happens to be. And a lot of people have viewed this as saying, I didn't do my planning based on Canada Pension. I heard all kinds of stories that the Canada Pension Plan was going to go broke someday. Well, that's not true. It's managed very, very well and it's performed excellent results. But the point is that the benefits that you receive are going to be taxed and maybe at the highest tax rate, right? And guess what? If you didn't have to spend it, you've accumulated it, and then the accumulation is going to be taxed again. So this becomes a real problem for some people, but I think it's an opportunity with respect to charitable gifting. So here's maybe a simplified strategy. Let's take that $26,000 per year in benefits on a joint life basis. Mr. and Mrs. 65-year-old here in our example, we use that $26,000 of CPP benefits and we acquire a $1.4 million insurance policy last to die. Now that's huge, right? And CoraLee talked about kind of the estate. The biggest tax year might be in your estate someday when all of these taxable assets basically have to be deemed to be disposed of, and maybe there's a $700,000 tax liability. Well, the tax savings from that $1.4 million insurance policy could more than offset the tax payable. Example. Okay, a lot of people haven't thought of using their Canada Pension Plan that way. Another possibility might be just using it this way, where we have a life insurance policy again, and we basically do the second setup that CoraLee talked about, where we name the Salvation Army the owner of that life insurance policy. In other words, make the charity the owner and the beneficiary. And then at last death, the $1.4 million goes to charity, the same way as it did before. But here, the payment of the benefits are donated to charity annually. That's the charitable receipt. So Mr. and Mrs. 65-year-old had $26,000 of CPP income, fully taxable. And now they've made a gift of $26,000 per year, donated to charity, full tax receipt, no tax during their lifetime, and a significant gift to charity. So whether it's the first strategy or the second strategy, there's a huge benefit taking place here to the Salvation Army. So both strategies, actually, the donor is using funds that maybe they considered as their never spend money. And the government is helping them. The CPP is helping them complete their charitable or philanthropic aspirations. The donor doesn't have to use their own cash flow, and they're able to minimize tax liability along the way. So give that some thought. Many people we know have not, but this is becoming an interesting way to give into the future. I will jump to now tying together gifting of retirement assets. This is something like George has actually already done. And in the first strategy, we have a situation where we know their RRSPs and RIFs are going to be taxed at second death at the highest possible tax rate. Okay, now this is where the government kind of isn't very friendly towards widowers, divorcees, and people without a spouse, simply because at first death, if you have a spouse, you can transfer these assets to the next generation, or not the next generation, to the surviving spouse. You can transfer them to him or her without any tax. But at the second death, the whole amount becomes taxable. And so in this case, on $1 million in the RIF and the RRSPs, there might be as much as $525,000 of tax to pay. And we can donate that RRSP and RIF amount to charity, something like you can do through your will, as George did. He just went to his financial institution and he's named them as the beneficiary, right? And so use the CPP benefits. Now, this is what I'm adding another element to this. I'm saying, okay, well, my family, and many people get concerned about this. You're saying, I'm giving away my entire $1 million of RRSP and RIF proceeds. I was intending some of that to go to my family. And so you could donate the RIF and RRSP proceeds to charity, eliminate the tax on them, and use the CPP benefits we were getting earlier to fund, say, a $525,000 life insurance policy. That would replace what the family would have received hadn't we done this at all. So I guess you can do both. You can fund the charity, and you could also make sure that your family was going to end up with what they would have otherwise. Now, moving along on the same vein, let's use that CPP benefit to fund a $500,000 insurance policy. By the way, that would be in the range of close to $9,000 to $10,000 for a 65-year-old couple, and the approximate tax on the RRSP. And then let's turn around and leave the full RRSP and RIF to the family. That whole $1 million ended up continuing to go to the family, right? So we've essentially then used the CPP insurance proceeds to pay the tax and leave the entire RIF in place. Another example, combining the retirement assets with the CPP. As I mentioned in my second CPP benefit, let's purchase a $1.4 million life policy, but rather than have it go to the charity, let's have it go to the family. And then on last death, let's give the entire RRSP and RIF proceeds basically to charity. The life insurance policy pays the 1.4 million tax-free to the family, and that's about 875 grand more than the previous example. Okay, where they were only going to be getting 525 left over. So we've strategically used CPP benefits or retirement assets and insurance, combining those things to actually multiply what your overall estate distribution was going to end up being. So CoraLee, what about marketable securities? We hear a lot about that. Can you help us understand that a bit?
Certainly. Yes, so marketable securities would fall into what might be in a non-registered investment portfolio for this discussion anyways. So this would be some stuff that you've invested that's outside of your RIF or your TFSA. So this is probably one of the more overlooked but very, very tax efficient methods of giving. So when you donate publicly traded securities, which would be stocks and bonds and mutual funds, it's very tax efficient. And the reason that is that normally if you have a underlying gain on your securities, you would pay a capital gain tax of 50% on whatever that gain amount was. But if you instead just move that security over to the charity, you would donate it in kind. You wouldn't liquidate it and then give the charity cash. What you do is you donate the security directly to the charity. Then the capital gain inclusion rate is 0. So if there had been quite a large gain, you would not be paying any tax on that gain. And then you would receive your donation receipt for the fair market value at the time that you had made the gift. So at the time that the security was transferred from your broker's account over to the charity. So let's just have a look at how this actually works. So in our traditional example here, we're going to assume that you had $50,000 in a mutual fund or stocks of some nature in a non-registered portfolio. Assuming that you bought it a number of years ago, perhaps your initial deposit was $10,000, so that's your cost basis, but it's grown to be $50,000 now. So there's an underlying capital gain there of $40,000. So in a normal scenario, if you were to sell this asset and take the cash out, you would have a capital gain of $20,000. That's the 50% of the $40,000 capital gain. And then whatever your marginal tax rate is, here we've just assumed it's 40%, you would be paying tax on that $20,000. So the tax here is $8,000. So if you run through it all the way, if you were to sell that asset, pay the tax, and then use the leftover cash to make a donation to charity, you'd be left with $42,000, and you've paid $8,000 of tax. But if we move along to the second option of just donating those securities directly to a charity, we can see a much, much better result. So you still have the $50,000 asset on your books, and there is still a gain there, but CRA wants to encourage people to do this. And so they have said, if you donate that directly to a charity, you don't need to pay any tax on the gain. So you can see that there's no tax payable, and the full $50,000 of value would be able to go to the charity. And of course, this works in any denomination of funds. So if you're thinking though, well, if I have this stock and it's a good investment, and I'd rather keep it for the long term, I don't really want to sell it, it's still a good, and perhaps you had cash that you would donate otherwise, it's still a good idea to donate this stock, receive the tax benefits of not having the capital gain, and then go ahead and give that to the charity. And then you can use your cash to repurchase that stock. But now it has a higher cost base. So you would buy it back at, say, $50,000. And then that's your higher cost base for the future. So it's just a really tax efficient way to make donations to a charity. And if it all sounds far too complex, the main takeaway here is just that if you have a non-registered portfolio or some stocks with gains in them, and you're making your annual donations or perhaps a special donation, just talk to your advisor and say, hey, I heard about donating marketable securities. Would this be a good option for me? If that was the one thing that you could remember is just think, oh, maybe that would be a good way to make a gift, a tax efficient way, because we spend a lot of time talking about things being tax efficient, and that's nice, but really what that enables you to do is give more. So that's I think what the really good part there is. And so Jerry's going to now talk about eliminating tax entirely.
Wow, that's a big task, isn't it? So oftentimes a couple might have their biggest tax bill, and we're going to look at 2 times. This might be when you pass away. There might be another time is when you sell your small business, let's say. But let's focus here on eliminating the tax when somebody passes away. So what we've mentioned before is when Mr. and Mrs. couple pass away, their estate basically, all their assets transfer to their estate. But let's take a closer look at all the assets. The way the CRA views this, it's as if you sold all those assets at the current market value. And CoraLee gave us an example of what happens when you sell assets that are subject to capital gain. There could be tax on 50% of that gain. If you've got assets like an apartment building that you've depreciated over the years, you've got what they call recapture depreciation. And if you have registered assets like the RSPs and RIFs we chatted about earlier, they're fully considered to be part of your income in the year in which you die. So what happens here, the terminal return is usually your biggest return in your lifetime. Well, it's before your death, but it's during your lifetime. A lot of taxable income happens as far as the CRA is concerned. So let's take a look at, can we look around and rummage around in the closet of assets for that couple? And if they've directed their executor and their estate to say, look, I'd like you to make a donation maybe that's big enough to offset the tax payable in the estate. And it is possible to make a donation from either of those assets to charity. And the charity then generates a tax receipt. And the tax receipt generates a credit. And the credit could be set up to be enough to offset the tax in its entirety. Better than that, in the year of death, when your estate is filing this tax return with this big credit, it might be more than the tax payable in the estate. So the good news is the government allows us to take a look at the donor's previous year, the year prior to death, that they could they could basically offset the tax that they paid in the previous year with part of this donation receipt. So it really works well. It is possible to offset all the tax with a tax credit. In other words, shift what you would have paid normally in tax, shift that to a gift to charity. I'm sure that everybody's excited about this opportunity. I certainly am. We have fun in working with our clients every day in helping them figure this kind of stuff out. So the quick example, I might have an estate with $1 million of tax exposure based on corporate shares. Nowadays, with the price of cottages going sky high, there could be lots of pent-up capital gains in cottages, non-registered investments, RSPs and RIFs. So let's say there's $1 million of tax in the estate. The idea would be, in the closet of assets, you find out what could the gift be. And here's where insurance particularly works well. Maybe you're saying, well, I don't have enough in kind of liquid things. I want to pass some of those things on, like the cottage, to the next generation. Well, simply have enough insurance in place that goes to the estate, so the estate could fulfill that $2 million gift. Guess what? That $2 million gift basically gets wiped out by the tax credit that the $2 million gift made. So that's our donate to eliminate strategy. One of the other major taxable events in somebody's lifetime is really when they sell their business. And across Saskatchewan, I mentioned earlier that business owners are probably some of the most generous people in our communities. So here's an example. In the year of the sale of the business, there may be a very large tax bill to pay. That's the time to strategize in that year with your tax advisors to give consideration to maybe making a gift. So my example here, I'm assuming a $2 million gain on shares of a privately owned company. And half of that, as CoraLee mentioned to us earlier, is taxable. The other half is tax-free. But on the taxable portion, there may be as much as $500,000 in taxes to pay. Okay, so the idea would be is that why don't we make a big enough gift of $1 million so that we receive a tax credit of that $500,000. Hey, the $500,000 of tax credit basically wipes out, or it replaces the $1 million of tax payable. And with that, maybe use some of the $1 million that you receive tax-free. And why not do this? Consider maybe buying a $1.5 million insurance policy with the family as the beneficiary. So at the end of the day, the life insurance policy death benefit reimburses the family for the million it lost because you gifted some away. And there's a cost to the insurance. The insurance wouldn't be free, but let's set up the insurance to basically make the family whole for the cost of insurance and the amount that's been given away. Sorry. So I just wanted to emphasize that. And in this case, what's happened here is that there was $2 million worth of shares before they sold. And after they sold, they lost $500,000 to tax. Well, what we ended up with here is there was zero tax. The charity ended up with $1.5 million, and the family ended up, the charity ended up with $1 million, and the family ended up with $1.5 million in total value. So in essence, we took a $2 million business asset and converted into estate distribution between family and charity of a total of $2.5 million. We multiplied what we were able to do with really the same dollars. So CoraLee, why don't you chat a little bit? A question came up in our conversation with Tim the other day on probate fees and things like that. So Tim, we thought we would just throw it up there and discuss it. What is probate all about?
Yeah, so we just briefly wanted to touch on this because there always seems to be a lot of questions surrounding probate. So in case there's some friends in Manitoba here today, we wanted to include you as well. I'll start there because it's the easy side. No, Manitoba no longer has probate fees, just recently. So that's good news over there. Here in Saskatchewan, the probate fee is 0.7 of 1% on any of the assets that are flowing through the estate. So that means if you have life insurance proceeds or other financial assets like your RIFs or other investments that have a named beneficiary, those would flow outside of your estate and would not be subject to probate. And then the question often comes up of who needs to get their estate probated. So if you ever have land in your estate that isn't held in a joint name, if you're the last person owning that land, the estate gets probated automatically. And then it just depends on what other assets you have in your estate. And most often it depends on the financial institution where they're held. So if you've got your investments at, RBC or Scotiabank or whatever institution it may be, each of them will have certain criteria for if they want those assets probated before they would release them to the estate. So overall, the probate fees are not generally high for most people. I think people generally worry about it, probably a little bit too much. Probate fees are only paid from your estate once you've passed away, if your estate is probated. And again, probably a little bit too much time is spent planning for something that doesn't end up being a very large cost for most individuals. So just kind of wrapping things up here, we just wanted to mention how important collaboration is in all of your estate planning endeavors, charitable and otherwise. If your lawyer and your tax advisor, your financial and insurance advisors can work together as a team and each bringing their own piece of puzzle of their knowledge to the bigger picture, that'll create the best scenario for the client to have all the pieces working together as they should. So collaboration is really important amongst the advisors. And then just a few takeaways. Even if you're not in the highest tax bracket for yourself, your charitable gift always creates a tax credit at that highest rate. So it always provides a really great benefit for the taxpayer. And then again, the government is looking for its piece at the last to die of a couple or for single people. So you'll have that tax bite of probably in the range of 25 to almost 50% on the last death. And then you have a choice of where your tax dollars go, as Jerry said, family, charity, or to tax. And if you want to be creative and you have that heart to give, you can pick your favorite too. And then of course, the best time to plan is today. And then you're going to need all the knowledge and wisdom that we all wish we would have to make the right decision for yourself and your family. So just wanted to say thank you very much. Thank you for having us, Tim. And we want to say mostly a big thank you to Tim and everyone at the Salvation Army for the amazing work that you all do every day, and especially in this very strange year with COVID. And then just as a parting word, we wanted to say, as part of our gratitude and to help in continuing the work, Continuity would like to make a $10,000 donation
Wow.
for you guys to continue all the amazing things that you're doing.
You guys are full of surprises. That's very generous. Thank you very, very much. Wow. Okay, you got to get me back into focus here for a second. That's Jerry and CoraLee. Thank you for everything. That was so much information. When I saw 6 points, I was thinking, how is he possibly going to get through all of this in half an hour? But that was jam-packed full, and so many really good things. I have a couple questions here. If you guys ready for a couple questions?
Absolutely.
Sure.
Okay, perfect. If anyone else has any questions, please use that chat button below. It's 10:48, so we have about 12 minutes to get through everything. One of the questions that I had is, what advice would you have on starting communication within a family regarding probable estate assets and their proposed distribution through the will? So I think the main question is, how do you start the conversation?
CoraLee, I will start with this. And if anybody would like a copy of a very, very good book on this, there's a gentleman by the name of Tom Deans has written a book called Willing Wisdom. And there is a really good roadmap and good questions to pose with your family in starting that conversation. So if anybody would like a copy of that book, we have multiple copies here, and touch base with us and we'll get a copy out to you, okay? But what that means though, what it means in having a conversation, I'll give you an example of what we did in our family. So I have a son and his wife and our 2 grandsons who live in London in the UK. I have kids that live here in Saskatoon, and we get to go to our family cabin. We've had our family cabin for 41 years. And it's kind of been a really small place. We expanded it, we knocked it down, we built a new place. And but anyway, it's been kind of where memories have been made for our entire family. So one summer when the kids from the UK were out, this was 2 years ago, and our kids from Saskatoon and all of their kids, we had the conversation. We started the conversation around the family dinner table. And so what do we want to do, family, with this cabin? We're getting long in the tooth. We're not going to be here forever. And immediately, as soon as we started bringing this up, they all turned pale and they were thinking, are you sick? Kind of thing, or what's wrong, right? No, we just think it's important that we lay the cards on the table and let you kids kind of figure out what you'd like to do with this very, very valuable asset that our family has grown up in, right? And that's just an example, Tim. So,
Right. So starting the conversation before you need one.
Correct.
Perfect.
Another thing that I'll mention that a few of our clients have perhaps enjoyed over the years is if there's a particularly difficult subject, they can blame their advisor for wanting to talk about it. And so you can say, you know what, my advisor really thinks we need to have a family meeting to go through some of these details. And then sometimes if you feel comfortable having that person present at the meeting as well, it gives you kind of an excuse for needing the meeting if you want to use one.
Well, good. Well, I'm glad that we can blame somebody. That's always good. All right, that was wonderful. I have another question here. Some of our donors, and I've spoken to some amazing people here in Saskatchewan, especially in Saskatoon. They've used the Just in Case binder by Harold Empey. Do you guys have anything similar to that? It's as a resource?
CoraLee, why don't you take this? Okay.
Yeah, sure. We have a binder that we have developed over the years, and it's very similar to the Just in Case binder. We have called ours the book, which we just kind of refer to it as, well, where would I find that information? How would I know who to call? Well, it's in the book. And so we have a number of those available here that we would be very happy to share with anyone who would like one. And it's just that book of, so if somebody's gone and the kids don't know who to call or where the details are, it's just a place to put everything that they would, know where to begin. And so, yeah, we have a bunch of those binders So if anybody wants to contact Tim, Tim can let us know, and we would be very happy to pass one on.
Perfect. Okay, and the last question I have, and forgive me if this makes it sound too simplistic. I've heard so many amazing strategies, and some things can be quite complex, but for a simple estate that may not have all of the complexities to it, what would be some good first steps? Just you start communicating with your family, and then what?
Well, definitely the communication first, because communication builds trust. And, but then I think it's important to map out for yourself. I mean, I'm talking maybe mom and dad, map out for themselves what they think they would like to do, right? And then I don't know who, they all have likely one number one advisor that they go to. It might be their tax advisor because they see their tax person once a year when it comes to compliance stuff. Or maybe it's their investment advisor, or it's their insurance advisor, or maybe it's their friendly lawyer who helped them prepare a will a number of years ago, right? I would say one of the first steps after mom and dad have figured out in their own language what is it that they would like, then they should make a first step and have this conversation with one of their professional advisors, whoever their main go-to person is. I think it's important to revisit this probably at least every 3 years. And then, but it's easier to do once you've got the conversation rolling, because then you have some people, other people who are interested in motivating you to move on.
Wow. Okay. So I am totally blown away by everything that we've talked about today. Thank you guys so much for sharing so much of your knowledge and information. I would also like to thank George Drever. George, thank you for sharing your heart and part of your story with us. I've always enjoyed talking to you. And that would actually conclude everything today. Thank you everyone for deciding to spend some time with us today. If you have any more questions, please send them my way. I would love to direct them either to Jerry or CoraLee, or try to help you with them in another way. Our information is on the screen now. Also, if you're in Manitoba, Diane Shack is also available to help with this. This has concluded everything that we have planned. I hope you guys have a wonderful week, and thanks again for attending.